What if I told you one of DeFi's OGs, a project that processed over $62 billion in trades, is in the middle of a complete reinvention? This isn't just an update, it's a bet on the entire future of decentralized finance. We're talking about Synthetix, and the big question is, can their radical new V3 model make SNX a deflationary powerhouse, or will it get crushed by the competition? Let's break it down. Alright, for anyone new to the game, Synthetix started with a revolutionary idea. Create synths, synthetic versions of any asset on the planet. Gold, dollars, Bitcoin, Tesla stock, you name it. The magic was its trading model. No order books, no slippage. You traded directly against a pooled collateral of SNX tokens. This meant infinite liquidity for any supported asset. It was groundbreaking and powered some of DeFi's top derivative platforms like Quant. But this model had a catch. A big one. To make it work, the SNX token had to be highly inflationary, constantly rewarding stakers to provide that collateral. High inflation is a ticking time bomb for any token's value. This is where they ripped up the playbook. The team knew the old model wasn't sustainable, so they didn't just patch it, they rebuilt it from the ground up with Synthetix V3. First, V3 kills the inflation. Let me say that again. The inflation is gone. So, how do stakers get paid? Simple, real yield. All rewards now come from trading fees generated by the protocol. If the protocol gets used, stakers earn. If it doesn't, they don't. Pure and simple economics. Second, and this is critical, V3 introduces a buyback and burn mechanism. A portion of the fees generated, especially from their new deployment on Base, is used to buy SNX off the open market and burn it forever. This puts deflationary pressure on the token. The more volume Synthetix processes, the more SNX gets torched. And third, Synthetix is no longer just a trading protocol. With V3, it's becoming a modular liquidity layer for all of DeFi. Anyone can build derivative markets on top of it, perps, options, sports betting, you name it. And they can use different types of collateral, like ETH or USDC, not just SNX. This is a massive shift. They're not competing to be the best trading app anymore. They're aiming to be the foundational railroad that all trading apps run on. Now, you might be thinking, great ideas, but can they actually generate volume? Well, they already have. The Perpetuals engine built on Synthetix V2 was a monster success. It quietly powered over $62 billion in cumulative trading volume. The problem was that the old V2 model wasn't efficient at capturing that value for SNX holders. V3 is designed to fix exactly that. The engine is proven. Now, they're just upgrading the chassis to capture the economic horsepower. Of course, it's not all sunshine and rainbows. The competition is fierce. You have dYdX, the order book king, and GMX, the master of real yield on Arbitrum.
Synthetix's bet is that by being the underlying infrastructure,
It won't have to compete directly. It wants to power the next dYdX or GMX. It's an ambitious play. But the biggest shadow looming over not just Synthetix, but all decentralized derivatives, is regulation. The term synthetic asset is a potential red flag for regulators like the SEC. Any crackdown on DeFi derivatives could hit Synthetix hard. This is the primary high-impact risk for any long-term thesis. So, what's the 3 to 5 year outlook? The bull case is clear. V3 works as designed. Developers flock to build on its flexible, multi-collateral liquidity layer. Trading volume explodes across dozens of new apps, generating massive fees. The buyback and burn mechanism kicks into high gear, making SNX a deflationary asset whose value is directly tied to the growth of the entire DeFi derivatives market. The bear case is just as stark. Regulatory FUD paralyzes the market. Developers choose simpler, more integrated platforms like GMX, or stick with established players like dYdX. The volume on V3 fails to materialize, the fees dry up, and without the fuel of inflation, the network stagnates. Synthetix is making one of the boldest pivots in DeFi history. They are sacrificing their old, inflationary model for a shot at becoming the fundamental liquidity backbone for on-chain derivatives.
backed by real yield and a deflationary token, it's a high-risk, high-reward play.
It's not about short-term price action. It's a bet on a complete architectural and economic redesign, paying off over the next several years. But what do you think? Is Synthetix V3 a game changer that will finally capture the protocol's immense value, or is the competition and regulatory risk too high? Drop your thoughts in the comments below. And if you want more deep dives like this, make sure to like, subscribe, and hit that notification bell. Let us know which altcoin we should analyze next. Thanks for watching, and we'll see you in the next one.